If you've tried to buy a home anytime recently, you know just how brutal it is out there. You're up against bidding wars, all cash offers, and prices that just seem to keep climbing. But what if I told you your biggest competition isn't another family, but a giant corporation with what feels like unlimited cash? Seriously, think about it. The buyer who just outbid you might not even be a person at all. It could be a massive company, one that's buying up dozens of homes in your area. So who are these new players on the block? Let's find out. All right, first up, let's meet these new players in the housing market. They're not always easy to spot, but believe me, their impact is very, very real. At the heart of all this is something called a REIT. That stands for Real Estate Investment Trust. The easiest way to think about it is like a mutual fund. But instead of buying stocks, a REIT pools a bunch of investor cash to buy up property or mortgages. And here's the kicker. They're required to pay out at least 90% of their taxable income as dividends. That makes them a super attractive investment. Now, not all REITs are the same. They basically come in two main flavors. You've got equity REITs. Think of them as the landlords. They're the ones buying up physical properties, like apartment buildings and rental homes, and they make their money from your rent check. Then you have mortgage REITs, or mREITs. They're the financiers. They don't own buildings, they own the loans on the buildings, and they profit from interest. Two totally different jobs in the market. So let's zoom in on those equity REITs first, the big corporate landlords. How exactly do they compete, and what does it mean when they move into your town? This is where you can really see the mismatch. You, the typical homebuyer, you're dealing with mortgages, inspections, and a closing process that can take weeks, even months. A REIT, on the other hand, waltzes in with an all-cash offer. They can close in days. And they're not just buying one house, they're buying up entire blocks. It's a whole different ballgame. So what does this actually do to a local market? Well, they're often targeting the exact same entry-level homes that first-time buyers are desperate for. That means more competition, plus every single house they buy gets pulled off the for-sale market and becomes a rental, sometimes forever. That shrinks the available supply for everyone else and can push rents up in the process. Okay, let's switch gears. We've talked about the landlords. Now let's dive into the financiers, the mortgage REITs. These guys operate more behind the scenes, but their influence is huge. Now, this is a really important point to get right. mREITs don't just decide what your mortgage rate is going to be. They're major participants for sure, but they're not the ones driving the bus. They're reacting to much bigger economic forces, especially what the Federal Reserve and the bond markets are doing. So how does that play out for you? Well, it's kind of like a domino effect. First, the Fed raises its rates. That makes it more expensive for the mREITs to borrow the money they use to buy mortgages, so their profit margins shrink. To lower their risk, they might start selling off some of their mortgage-backed securities, and when you flood the market with more of anything, its price can drop, which, in this world, can push the underlying interest rates higher for you, the home buyer. Okay, so we've seen how these companies operate. Now for the really fascinating part. Where are they doing it? Because this isn't happening evenly across the country. Oh no, it's incredibly concentrated. If you just look at the national numbers, you might kind of shrug. On average, institutional investors own maybe 2 to 3% of all single-family homes. It sounds tiny, right? Almost like a rounding error. But that national number is hiding the real story. And boom, here is the real story. Just look at that difference. The national average is down here at 3%. But in a city like Atlanta, it's estimated that institutional investors own around 27% of all single-family rental homes. That's not a small footprint. That's a giant one. And Atlanta isn't some weird outlier. It's part of a very clear pattern. Look at the Sun Belt, Jacksonville, Charlotte, Dallas, Phoenix. All of these cities have a massive corporate landlord presence. And why there? It's the perfect recipe. Populations are booming, there's huge demand for rentals, and home prices were, at least historically, more affordable. So, does this mean REITs are the #1 villain in the story of high home prices? Well, to answer that, we need to zoom out and look at the whole picture. This really puts things in perspective. See that tiny slice? That's institutional investment. Yes, it's a factor, but look at the biggest slice of the pie. The main reason housing is so expensive is because, for decades, we just haven't built enough of it. That fundamental shortage is the real problem. Things like zoning laws and high construction costs make it worse. REITs are basically throwing fuel on a fire that was already burning. So if there's one key takeaway here, it's this. Equity REITs, the landlords, have a direct and very local impact. They're buying up your neighbor's house and setting the rent in specific hotspots. mREITs, the financiers, have a much broader national impact by influencing the financial markets that help determine what mortgage rate we all pay. But this story isn't over. In fact, the strategy is changing, and this next evolution tells us a whole lot about where the future of housing is headed. The latest big trend is what's called build to rent. Instead of just buying up existing houses one by one, these huge investors are now building entire brand new neighborhoods from scratch with one purpose: to rent them all out. And from their point of view, this makes a ton of sense. There's this huge generation of people who want the suburban house with a yard, but they can't afford the down payment. This meets that demand. It's also a great place for investors to park their cash, especially with office buildings looking like a shaky bet these days. But think about the implications. A future with entire communities of permanent renters, building equity for shareholders they'll never meet. And that really brings us to the fundamental question at the bottom of all of this. What is a house? Is it primarily a home, a place for family and community? Or is it just another financial asset traded on a global market like a stock or a bond? The answer to that question could redefine the American dream for generations to come.